Good evening, everyone. Welcome to our Oklahoma State Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. Thank you for taking time out of your busy schedules. I know it's right around dinner time right now, depending on what time zone you're in. So really excited to be able to bring this content to you. This is a class that we get a chance to teach once a quarter through the Alumni Association. It's been really well participated in. And we've had the pleasure of helping several of your fellow alum in the journey towards homeownership. So hopefully you're hearing some good things out in the alumni community about the valuable classes that we're providing. And our goal is to obviously impart some really great ideas around homeownership for you, and so you have a few takeaways as you're considering homeownership for the future. You're going to hear me talk tonight a little bit about the buying process and all the tools and resources that are available to you. Love to be able to get connected with you after today's session, just so I can help kind of be a partner for you on achieving that goal of home ownership. Now, I work for an organization called APM, or American Pacific Mortgage. We're one of the largest lenders in the country. And our team in particular focuses on providing first-time homebuyer resources through our classwork that we do all across the country. We'll help educate over 10,000 individuals in homeownership this year. So I'm really passionate about kind of serving our community with these educational tools. And really excited that you guys could be a part of this journey tonight. This is a very interactive session. So as we go through tonight's class, I encourage you to ask questions of us. You can use the chat feature or Q&A in Zoom. I'll be monitoring both of those windows, and if something pops up, obviously we'll kind of share that back with the class, but we want to make this very interactive, kind of keep you engaged throughout the class. Our runtime will take us up just before the top of the hour, and we're going to record tonight's class and share back all of our material to you tomorrow, so you can do some look backs to some of your notes, and hopefully you have a lot of great things to take away from this evening's class. Well, our talking points are going to look like this, which will include thinking about or talking a little bit about the housing market, what's happening with interest rates. We'll walk you through a rent versus buying calculator to help kind of frame up for you a little bit about what does it look like to purchase versus kind of continuing to rent if that's the choice I make. We'll spend some time talking a little bit about credit, some tips and tricks around that to help you build maybe your credit up a little bit. We'll look at various loan programs that are available to you, including assistance programs that are offered to you. We will spend tonight, if you're looking to purchase in the state of Oklahoma, we'll go through the OHFA program, kind of give you some ideas around that. In fact, we just helped one of our buyers a couple of weeks ago close on the OHFA program, which will provide assistance to you. So we'll look at that. And that'll be into our first-time homebuyer segment, as you can see on slide. We'll also talk about savings for home ownership, because not all of us will be either eligible or maybe need a little bit more support. So we'll talk about how we save to reach our goals of home ownership. I also want to talk you through the buying process. After leaving tonight's class, hopefully you're a little bit more excited about home ownership and feel like, hey, this is a real goal that I can achieve. I'm going to walk you through the buying process and how we go from attending a class like this to getting on the path towards home ownership, and how we get started with our free consultation. All right, so that's our plan for tonight. Really, again, excited for you to help us and be a part of this class so we can kind of help you explore home ownership. Now, as we think about home ownership, this is a big financial decision, and it doesn't make sense for everyone, but for those that are in a great financial position, or maybe getting into an improved position, we want to make sure that we understand, does it make sense for us? And there's the stability that we can create in our household budget with home ownership, because we don't have to worry about our rent increasing on an annual basis when we decide to maybe renew our lease. Many of our clients that are buying in today's market, while rates might be a little bit elevated, they will have a future refinance opportunity. So when rates maybe drop by a full 1%, we're thinking about refinancing our home. This is an asset that should grow over time. So whatever level of price I buy at, that home hopefully will go up in value as the market value increases in my home and I pay down my mortgage. The difference in the market value versus the loan balance is called home equity. And for most of us, that's like our number one asset that we have, in addition to, say, retirement funds or like a 401k. And there's some great tax benefits that come along with owning a home. Many of us that are considering home ownership don't think about that. Potential tax deductibility of interest and potential tax benefits with energy efficient upgrades that I make to my home. So, when we think about comparing our rent budget today versus what our home ownership budget looks like, It's not necessarily the same because we really want to add in those really important ingredients like tax savings, equity appreciation. Those are all really important things to consider in home ownership. I wanted to walk our class as we're launching into our discussion tonight is to kind of take a look at one of our calculators that's available on our website. And it's called our rent versus buying calculator. And this is one of the exercises that we go through as part of your free consultation that we do with you in building your home buying plan. So in our classes, we like to kind of walk our students through some of the data points of this calculator, because I think it's really important to better understand the benefits of home ownership. So for time purposes, we've already kind of pre-filled in some of the data points here. Like, for example, we're looking at buying a $300,000 house in this scenario with a minimum down payment of 3%. We're going to talk more about programs in just a bit when we go through our programs segment. But ultimately, on a conventional loan, the minimum down payment is 3%, which means I would be financing in this scenario $291,000 with an average interest rate of, say, 6.4. We have a 30-year fixed mortgage. So that's what we would be looking at. And that's typical for most first-time buyers. And we'll just make the assumption that we're going to buy our house, let's say, in the month of July. Now, when we put less than 20% down, we're going to have mortgage insurance on my home. Mortgage insurance, as you'll learn a little bit later in tonight's class, is based upon credit score, down payment, and how much I finance. We also have homeowners insurance, which will vary based upon where in the country I want to buy, what I want to buy. But in this exercise, we put $2,500 for our homeowners insurance, taxes based upon the acquisition price of my home. Maybe I'm thinking about buying a condominium, maybe a townhouse. Then we want to factor in HOA fees. And then we've already talked a little bit about this, but tax benefits. So what tax bracket am I at? So this particular buyer is at a 24% tax bracket. Then we want to factor in the cost of maintaining my home. Maybe eventually I'll sell my house. So maybe 7 years from now, I decide to sell, cash out some of my equity. What's that going to cost me? And then the appreciation in my home. How much will my home go up in value every year? So that's all in the column of home ownership. Now on the rental side, let's assume that I'm paying $1,500 a month in rent. Renter's insurance is about 1.3% of that rental amount, and that my rent's going to go up 3% every year while I stay in that place. Okay, so that would be kind of our side-by-side comparison with this discussion. So our calculator goes and says, okay, well, if we make all these assumptions, then it looks like by owning a home or purchasing a home, I should say, in the amount of $300,000, I can break even on my investment in 3 years. So the down payment that I have to outlay for the closing costs that I have to put out of pocket, I will break even in that investment in 3 years. And generally, as I coach clients in home ownership, we want that break even to be 4 years or less. So 3 years is awesome. Now, it differs for every buyer's scenario, but ultimately, we would want to see that break even in 4 years or less. Now, where it gets a little bit more exciting is that as I hold on to my house, let's say over 7 years, I've had my house for 7 years. Now, after 7 years, now I'm $38,000 ahead of buying versus renting. So 7 years, I've thrown almost $140,000 in rental payments to my landlord. Probably I've paid down his mortgage or her mortgage. And then on the buy side, I now have my equity appreciation. I now have my tax benefits. So my net positive, or my net expense, I should say, is $101,000. If we look at it from an equity perspective, now my equity has potentially grown over $100,000 over 7 years. Now, every market across the country is a little bit different. It's not going to be every year equity appreciation, 3%, 5%. I mean, this is over a span of time, but clearly, as you compare and contrast home ownership versus renting, there truly is an opportunity in home ownership. And so that's why I kind of encourage our classes to think more about it. And, not everybody's currently ready for home ownership, but I think classes like this can help give you some ideas and maybe spark some thoughts around, hey, this could be a goal that I want to have on my radar, right? Now, the housing market and what it looks like in various parts of the country will play a role in my time that I decide to enter into home ownership. Now, because we're doing an Oklahoma State class, I know not everyone in class is going to buy in Oklahoma, but let's just use Oklahoma as a point of reference. Certainly, I can take some questions of other parts of the country and kind of give you my commentary. If we look at the Oklahoma housing market over the last 3 years, median sales price is just over $250,000. The median home that stays on the market is about 47 days, which is pretty much in line with most parts of the country. If we look at neighboring states like Texas, if we go down in south, like in Georgia, Colorado, we are seeing some longer market times in some of those markets. Florida, for example, we're seeing some of those states be some of the longest inventory markets. So meaning they have the most inventory available to buyers, and it's really a buyer's market in those states. Oklahoma, probably closer to a buyer's market, if you will. I know right now we're in the spring and summer buying season right now, so we see more sellers active with putting their homes on the market. And we're seeing more buyers in the market. And even though interest rates are still at elevated levels, which we'll talk about in just a few minutes, we're still seeing a lot of buyer activity in today's market. In Oklahoma, number of homes sold is up 5.9%. The homes have stayed on the market, a little bit longer, so we're up 4% in that regard. But you are seeing a little upward trend in market value in the Oklahoma housing market. And so encouraging sign there. Maybe it's because OKC is a top-notch NBA team. Maybe that's driving the prices up. But with all joking aside, though, obviously a lot of buyers are trying to go to more cost-effective or more affordable markets, and I think you can certainly consider Oklahoma as one of those markets. If you'd like to talk through any other housing markets, feel free to drop that in the chat or the Q&A. I'm more than happy to kind of comment on some of the other markets that we serve across the country. Interest rates are going to play a role in our entry point to homeownership and really our affordability points. Now, interest rates are in a very volatile position right now. Interest rates vary day by day, not just from what economic data is coming out, but really what's happening with the conflict in the Middle East right now. So the on-again, off-again peace negotiations are really kind of making the markets go in kind of more of a roller coaster fashion. You can just see it in our last 12 months of, really, because since the conflict broke out around here, you can see interest rates just kind of really being all over the board. Hopefully, we'll see resolution there that will kind of calm the markets a little bit. But at the end of the day, the Federal Reserve is still looking at two kind of big factors in future rate cuts. Do we hit inflation at 2% levels? We're still at elevated inflation levels. And then what's the health of our job markets look like? So, we'll have to see with the new Fed chairman coming in, with Kevin Warsh coming in and taking over at the helm. We'll see maybe how monetary policy shifts a little bit. Still kind of too new to really see which directionally what we're going to go. The kind of the cloud over the markets right now is just kind of what's happening in the Middle East. And hopefully, like I said, if we can get some resolution there, we'll maybe see the market kind of simmer down a little bit. Now, interest rates change daily throughout the trading day on Wall Street. So interest rates will start beginning their activity at 6 a.m. Pacific time and end at 2 p.m. Pacific time. So whatever time zone you're in, you can kind of do the math. But ultimately, those interest rates change by the minute during the trading day. And interest rates on a mortgage have different characteristics that make up what your interest rate is going to be. That would include credit score and eligibility for a specific program or product, what your down payment might look like. You do have the option to buy what we call as points to bring down your interest rate. Usually 1 point is the equivalent of 1% to my loan amount, which will drive down my interest rate output about 0.25%. In today's market, they were at elevated levels, not an investment that I would probably recommend for most buyers unless we have to, just from an affordability perspective, because most of our clients buying in today's market are probably going to consider refinancing in a couple of years once rates start to normalize. And then the term of my loan can also reduce what my interest rate looks like. So the shorter my term is, the much improved my interest rate is going to be. You've heard me talk earlier about our consultation that we do with clients. And so, I'll walk you through some different ideas around homeownership. We'll figure out the right budget for you as we consider different products that are available to you. And of course, different assistance programs that are available to help support you in your goals of homeownership. Now, as we think about our plan for homeownership, we also want to talk about credit, because credit can drive the cost of your financing and ultimately the product that you select. every loan program has a minimum credit score. And we put those products up on screen here so you can get a sense of that. So really the lowest credit score we can go down to is about a 580 credit score. And our goal in consulting with our clients is to see how we can help optimize your credit score. Everyone that we work with all across the country is in different financial positions, but it's really important for us to help credit coach clients up to help you maximize your savings in home ownership. Now, there are 3 different models to credit scoring, and the models are for consumer credit cards, there's auto financing, and then there's the mortgage model. So for those of you that monitor your credit on a daily, weekly, monthly basis, whatever the case may be, more than likely the score that you're seeing in some of your tools is a credit card score. Now, in home financing, obviously, we're using a mortgage model, so there might be a little bit of variance between the 2 scores. Now, every agency has a different score model. So the 3 agencies, as you guys are probably well aware of, are Equifax, Experian, and TransUnion. And we take the middle credit score of all 3 of their reporting scores that come out. So if my highest score is 800 and my middle score is 760 and my lowest score is 740, well, we're going to use that 760 score as our middle score for qualifying purposes, which will drive the cost of my interest rate, the product selection, maybe even the cost of mortgage insurance. Now, if I'm going to apply with my partner and my partner's middle score is 720 as opposed to my 760 score, well, that might impact my interest rate offering that I get. So as we have these discussions on how to improve your financial position from a credit perspective with home financing, we're going to see ways that maybe we can pay down debt or do different things to help improve your credit score. Now, we're going to talk more about credit scoring and the modeling for scores in just a bit, but I do want to share with you just a matrix around what or how long negative items will stay with you on your credit report. So whether it's a hard credit inquiry or maybe more severe things like late payments or over limits, this is how long they'll stay with you on your credit report. Now, if I've had some past challenges, maybe I was late on a student loan payment a couple of years ago, the impact to my credit score will be within the most recent 12 to 24 months from the date of the late last payment. So if I just had a late payment in October of 25, I'm probably going to see a little bit more impact to my score than maybe a late payment that I had maybe back in 2023, because it's now over that 24-month period. Now, as I mentioned earlier, there's different models to credit scoring. This is what the score calculation model looks like for the housing side of things. And so I want to kind of walk you through this. My goal in sharing this with you in class is to maybe give you some ideas of areas of opportunity for you on your own credit score. 15% of the credit model is how long have you had credit. So, the more mature my credit file is, probably the more improved my credit score is going to be. If I have new credit that I'm trying to get access to, so if I'm going to be opening up a lot of new accounts, new credit cards, car loans, maybe a mortgage, that's going to be 20% of the weighting for the score. Those inquiries that you make on your credit report can be big impact items to your credit score. We really want to avoid hard inquiries, especially in the most recent 6 to 12 months on your credit file. Now, that includes mortgage, auto, credit cards, whatever you're applying for. And our process is a little bit different in working with our clients. We only start with what we call as a soft credit check as you kind of work with us on your consultation. And the reason why we choose to do a soft credit check is because a soft credit check does not impact your credit score. And so we can help kind of guide you in homeownership without impacting your score. At the same time, there are rules in place in the score models that state that if you apply for, say, a mortgage, you do have a 30-day window of time to shop around with as many lenders as you want. And it's the equivalent of one credit inquiry to your score, credit hit to your score. However, again, in our APM process, it just starts with a soft credit check. Now, this is probably the biggest area of opportunity for most clients, and that's around revolving debt. We're looking at the amount of balances I'm carrying on my credit cards versus what my credit limits are. Ideally, we want those balances to be at 10% or less of my credit limits. If I'm running a little bit higher on my balances, maybe I'm at 80% of my limits, well, I probably have now seen some pullback in my credit score. I would encourage our client to try to start working to get below 50% in utilization or balances to credit limits. Then the next step would be 30%, and then ideally to get to 10% or less. If you're trying to get to an 800 credit score and maybe you're at 740, that could be the area of opportunity to help get you to that next level of scoring. Now, one of the tips I always like to share with our class is how to manage down credit card debt. So if you look at one of your credit cards, just pick one of them. There's probably a billing cycle date, and then of course there's a due date, right? The billing cycle date is the date at which the credit card issuer or creditor sends out all your information out to the credit agencies, and they report your balance, your pay history, and your activity, right? So all your charges. What I would encourage our class to do is try to pay down that account before the billing cycle date closes, or pay it off ideally. Because if you can do that, you can get ahead of the reporting out to the credit agencies, therefore showing a much lower utilization level, improving your credit score. And then, of course, when we start having conversations around optimizing your financing selection, you'll have the best possible credit score. All right. Now, next section is payment history. That's pretty self-explanatory. In that section, we're looking at how have I paid my bills, right? And if I've had some past challenges, as we talked about earlier, in the most recent 12 to 24 months, it's going to impact the credit score. But how severe are those late payments? Are they 30-day lates, 60-day lates, or 90-day plus day delinquencies? The more severe the impact to the credit score, the bigger impact it's going to have the more late payment I have, the higher impact it's going to have to my credit score. Now, one of the accounts that shows up on our credit files is going to be student loans. And so I always like to talk a little bit about student loans in our classes, just to provide a little bit more context around how we view student loans from the lending perspective. So if I'm currently active in repayment, and let's say I have $75,000 in debt and I'm paying $250 per month, we can use that $250 payment right away for qualifying. That's not a problem. Where it gets a little bit more challenging, and probably there isn't a day that goes by that I don't have these type of conversations, is that I'm currently in forbearance, or maybe I'm in deferment, maybe I'm in a public forgiveness program. Whatever the case may be, if I'm not actively making payments, then in the lending world, we do have to count a minimum payment to qualify. So we have to look at your expenses versus your income. So if I have that $75,000 balance in student loans and I'm not making payments, then if I'm applying for an FHA loan, we would have to use 0.5% of the outstanding balances to determine a qualifying payment, or 1% on a conventional Fannie Mae loan. And that could change, obviously, what our eligibility looks like for a specific loan product. It's always best if our clients are in income-based repayment programs or savings plans, but that generally gives us a lower payment for qualifying. But it just depends on where we're at and how much student loan debt we're carrying. At the end of the day, since student loans are just a reality for most of the clients that I work with across the country, we want to kind of just make sure we dispel any myths around student loans, that they're not going to hold you back from home ownership. We just got to better understand, where you're at with those student loan payments and how they impact your eligibility for a specific price of home. Now, the reason why we have to do that too is because every loan program has guidelines that focus on, or not just on student loans, but they do speak to student loans. And so we have to make sure that as we work with buyers, that we're going to meet the eligibility requirements for a specific loan program. In this program segment, I want to give you kind of a high-level look at different products that are available to you. Some of the terminology that I share with you this evening, you've probably heard about, or maybe kind of just done some searches already, so you get this stuff. But I want to kind of just give you a high-level look at things. And the first one is the conventional loan. That's a Fannie Mae, Freddie Mac loan, has a minimum down payment of 3%. And up to a loan amount of $832,750. We call that the conforming loan limit. In some markets, say Virginia, California, we call them high cost of living markets. You can go beyond $832,750, but when you do, that minimum down payment jumps from 3% to 5%. In Oklahoma, for example, we can borrow up to that $832,750 with a 3% down option for a first-time buyer. The next product is an FHA loan. That is a government-insured loan, and that has a minimum down payment of 3.5% with lower credit score requirements. And then the maximum loan amount will change based upon what county I'm going to buy in. The FHA loan and USDA loan are both government-insured loans. The difference is USDA focuses on more rural areas, and the benefit around the USDA program is it provides 100% financing to purchase in some of those rural areas. Many of those areas can be in the state of Oklahoma. And that loan amount will change based upon where in the state that you're going to purchase. FHA and both USDA, because they are government insured loans, there are residency requirements with those products. You do have to be a permanent resident to participate in those programs, unfortunately. Now, regardless of your resident status with a conventional loan, you can be a non-permanent resident, still get access to that program. But the two government insured products do require that permanent resident status. The jumbo loan is for clients that are going to purchase kind of above the conforming, or we call high balance loan limits, but it does have higher down payment requirements and higher credit score requirements. And then the VA home loan is for our veterans that have eligibility for the VA home loan. It's a zero down payment option, flexible credit score requirements and expense ratios. And there's really no maximum loan amount for the veteran. So we really want to obviously include participation in home ownership for the veteran. So we try to have a very flexible eligibility standard for the veteran. Now, not shown here on screen is our physician's loan program. So if you're a practicing physician or a residency right now and are still looking to purchase, the physician's loan provides a little bit more flexibility when it comes to student loan repayment. I know we went through a segment around student loans, but a physician's loan will give a little more leniency when it comes to how we view payments or future payments on student loans. Now, one of the things that comes into view for product selection is going to be what we call mortgage insurance, or PMI. And so we want to just kind of explain to you a little bit more about what is PMI. A lot of confusion in the marketplace around that, and what does it do, and how do I pay for it, that kind of thing. So let's kind of walk through that. Now, there's two forms of mortgage insurance when it comes to lending. There's PMI, which is called private mortgage insurance. That's with a conventional loan. And then on an FHA loan, there's mortgage insurance premium, or MIP. So let's kind of dive into each one of those topics a little bit closer. Now, the conventional loan PMI is going to be based upon down payment, credit score, and then how much you finance. So the higher my credit score is, the more I put down, probably the cheaper my mortgage insurance is going to be. And one of the benefits with a conventional loan is that it does have a cancellation option on PMI, so that when I reach 2 years in my home and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. So we've kind of shown you a payment example on screen here. So with an conventional loan with 3% down, we're probably looking at PMI around $85 a month. So pretty reasonable considering the amount of down payment. Higher I can move that down payment, higher I can move my credit score, the cheaper that mortgage insurance is going to be. Now, on the FHA side of things, it looks a little bit different. There's actually two forms of mortgage insurance with FHA. There's monthly mortgage insurance, and there's also upfront mortgage insurance. And you can only cancel mortgage insurance on an FHA loan by refinancing out of the FHA loan into a conventional loan. So one of the benefits for the conventional loan is having that cancellation option. And if we look at the payment options on the FHA loan, upfront mortgage insurance is now 1.75% of my loan amount. So that gets added into my total amount financed. And then I also have that monthly mortgage insurance that's at $116 per month. So, clearly the FHA loan is going to be much more expensive from a mortgage insurance perspective versus the conventional loan. One of the things I found in conversations with clients that, you don't always see online, especially when you're searching product or interest rates in the mortgage space, is that you'll generally see FHA rates about 1/4 to 0.5% lower than conventional loans. But what you don't see when you look closer is that the FHA mortgage insurance is going to be much more expensive than the conventional product. If you're one of our higher credit score customers, 680, 700 or higher, definitely we want to first consider the conventional loan product, because it is going to have a cheaper expense structure for you and give you that cancellation option. But ultimately, we're going to kind of figure out what's the right product match for you, because an FHA can still provide a great support for our buyers, especially if we need a little bit more support around credit minimums or just leniency in expenses. FHA will provide us that. All right, before I get into employment and income scenarios, I just want to kind of take a quick pause. I know we've been kind of moving pretty fast, but any questions from our class so far on any of our topics that we've kind of been exploring? All right, okay. Again, feel free to drop something in the chat or Q&A. I'll take a peek at it and we'll talk through it in class. I want to kind of spend some time talking a little bit about employment scenarios and income. And before we do that, I wanted to share with you some of the documentation that we'll generally ask for as we start the buying process together and explore different options for you. So you can kind of see those on screen. Pretty simple stuff. If I work for an employer, I'm going to need the last 2 years of W-2s available, last 30 to 60 days of pay stubs, and then from an asset perspective, last couple months of bank statements. So that's pretty standard stuff that you can upload right to your application as you start the buying journey with us. Let's talk through some different employment scenarios, because I think it's pretty helpful as we go through our classes. In lending, we have to kind of put together a 2-year history, which that history can include employment and or education. So you don't necessarily have to be on the job 2 years to be eligible for financing. You could be, out of school, for example, You could just be graduating this spring and be taking on a job this summer and get qualified for a mortgage. So you can qualify for a mortgage with as little as just an offer letter. In fact, we have one of our university partner clients is buying a house and closing escrow next week, and they have still yet to start their job. And so that is an option for you. So we just have to really understand your 2 years of education and or work history to qualify for a mortgage. If you're in a variable compensation role, so let's say you have a base salary, but you also get bonuses or you get commissions, or maybe you're in an hourly role and you get overtime. In that case, we do have to show a 2-year track record with that employer so we can kind of average those variable earning components over the last 2 years. Okay, so that's where we kind of have to look at that. If you're in maybe a tech position, maybe you get RSUs or restricted shares, and you want to use some of your vested RSUs towards qualifying, we can certainly also look at that as well too. In that case, we also have to show that you've been on the job for at least 2 years to qualify with that additional stream of income. If you're a self-employed individual, we do have to show at least 2 years of filed tax returns as a self-employed individual in order to be eligible for financing. So that's where that's going to be a requirement for most self-employed individuals. If you have an alternative job that you're working at, so let's say I'm a full-time 40-hour work week employee, I should say, but I also have a job where I drive for Uber or DoorDash or whatever. If you want to count both sources of income, then you have to show that you've been doing both jobs simultaneously for at least 2 years. Same thing would hold true for multiple employers. So sometimes in the healthcare industry, we'll have like a nurse that works for 2 different medical centers, right? To be able to count both sources of income, we have to show that you've been on the job with both employers for 2 years, right? Part-time jobs as well too. We have to show that we've had a 2-year 2-year timeline with those employers, just because when you have variable sources, as you're kind of probably figuring out now, we have to be able to show some historical data to be able to average those hours. Okay. And then last thing I just want to share with you is that sometimes we'll have clients as they apply for home financing, they're getting supplemental income from a partner that maybe helps contribute to the household expenses, or maybe they're renting out a room, whatever the case may be. I can't count that source of income, or I can't offset these expenses for my new home purchase unless my partner is going to be a part of the loan application. All right. I did get a question that popped up, and we'll take on this question, and then we'll talk a little bit about looking at expenses versus income. The question was, how do down payment assistance programs in Oklahoma come into play with conventional or FHA loans? We're going to talk about assistance programs in just a minute. We're going to go through the OHFA program. Ultimately, you can get assistance to help towards your down payment and closing costs. That's available in Oklahoma, and there's income limits, for you to be able to participate in those programs. But I'll walk you through that in our first-time buyer segment. So yeah, for sure. Let's look at just a quick metric that we use in lending. It's called debt to income ratio, and it essentially looks at your existing debts today, which would include credit cards, personal loans, auto payments, whatever the case may be, plus what your projected housing payment's going to be, principal and interest of your new mortgage, your property taxes, your homeowner's insurance. Maybe you're going to put less than 20% down, and you're going to have PMI or private mortgage insurance. That all gets baked into our payment calculation. If I'm buying a condo or a townhouse, then we want to think about adding the HOA fees in. And so we have a calculation that's on screen here. We have an assumption that someone's going to be paying, say, $2,000 a month in those housing expenses, and they're paying $500 in other existing expenses, right? So if we have $2,500 in expenses, we want to compare that to the $8,000 that they're making in income pre-tax right now. And the debt to income ratio essentially tells us how much of that pre-tax income is going out to those expenses. Now, the guidelines allow us to go up to 45, even 50% expense ratio. This particular scenario you see on screen, we have a 31.2% debt to income ratio. So that client's in a really good spot. I'd say, the sweet spot for most clients is probably 33 to 36% debt to income ratio. In more affordable parts across the country, that's kind of where we see it, even less than sometimes. But the guidelines allow those expenses to go as high as 45 to 50%. That's part of the guidelines for lending, but it doesn't really make up affordability. Affordability is one of those conversations that we're going to have as part of your consultation. So we want to make sure that your plan for homeownership is affordable, but also sustainable over time. So if you have little bumps in the road economically, you can still afford your home and not have any challenges there. So, but those are one of the calculations we go through. Next thing I want to share with you, and then we'll kind of weave this into assistance programs, which is the question we just got, is down payment for homeownership. Now, when we think about savings for homeownership, we're going to have to prepare for down payment, but there's also what we call closing costs to buy a house. And closing costs, depending on where we're going to buy in the country, can be anywhere between 2 to 3% of my total purchase price. And so that's where we want to think about when it comes to savings for homeownership. Now, there's various sources that are eligible to use to put into your home buying plan. Obviously, checking and savings accounts can be used. We have to make sure all assets are seasoned at least 60 days to be able to use in financing. So cash is not acceptable, but if you've had a deposit that's in your account and it's at least seasoned out 60 days, that's totally fine in financing. So we're looking at large deposits when we verify assets. If you just got your tax refund, that is a sourceable asset, so that's totally fine. But we look at accounts, like I said, checking and savings accounts, retirement accounts can be used, 401ks, 403bs. When you're getting into investment accounts, I always encourage clients, talk to your professional advisor and just see if that's the right move for you financially. Even gift funds can be used, and that's where a family member is contributing towards your home purchase. Those funds do not need to be seasoned, but there's just a documentation process to kind of verify the funds being used in the purchase. Now, as I think about kind of coaching clients in home ownership, there's probably the big challenges of reaching that goals of home ownership, and it really centers around savings for home ownership. And I understand with just the cost of living out there, things can be difficult for many. And so as we kind of coach you through home ownership, we always like to share with clients what we call a savings plan to reach your home ownership goals. It's a very simple approach to savings, but I think it's pretty effective. And it also builds up kind of your tolerance level of what the monthly payment's going to look like for your housing expense. So it looks like this. So if I'm currently in a position where I'm paying, let's say, $1,500 a month in rent, but after going through a consultation with me, we kind of feel like our projected mortgage payment will be about $3,000 because I think I can make that work given where my bills are at today and what I'm making in income. So if we were to adopt that $3,000 as our savings budget on a monthly basis, which basically means is that on the first of the month, when I'm making my rent payment of $1,500, I take an additional $1,500 and I transfer that right to my savings account. And I do that every month at the first of the month. I pay my landlord, I transfer $1,500, and that is creating that discipline and habit of savings like I'm actually making that $3,000 mortgage payment. And, after the end of 6 months, I have $9,000 accrued to my savings account. At the end of a year, it's $18,000, not including, an interest-bearing account that you can get from a high-yield account. So that is a great way of establishing savings. At the same time, building that, like I said, tolerance or just understanding like what it's going to take to be able to pay that $3,000 on a monthly basis in mortgage. So that's our savings plan. And, I know in some regards that's probably easier said than done, but it is a really simple approach to start building up those resources for home ownership. Now, the question we got earlier was around first-time homebuyer programs. And in Oklahoma, we have the OHFA program, which is a fantastic program. You can get resources to help you in assistance funds of up to 3.5% in resources towards your home purchase plan. There are special incentives for state employees, teachers, first responders. But this is a fantastic program that has a low interest option and some forgivable options as well too. With these assistance resources. So they're basically used to fund down payment as well as closing costs in your home purchase plan. They also can be set up with additional assistance programs. For example, we had one of our clients that was a member of a tribe in Oklahoma. We were able to utilize some resources they received from their tribe as well as the OHFA program. So those are some complementary programs that you can use in your path towards home ownership as a first-time buyer. Now, if you're not in Oklahoma, there are other states that have very similar programs or HFAs. So we can certainly talk offline, and as we can do a consultation with you and figure out what your plan for home ownership looks like, we'll see and explore different first-time buyer resources that we can put into your plan. Now, within APM, we also have some other internal programs like our Pathway DPA program. which is available on an FHA loan, and it provides assistance of anywhere between 3.5% to 5% in assistance funds. And for clients that make less than 80% of the median income, there's our APM 1% down program, which essentially means if you contribute 1% of your own funds, then the company will grant you another 2% to make up the 3% minimum conventional down payment option. So that's a really cool product. And then if you're considered low income or very low income, Fannie Mae does offer some different grants too. They're not huge grants, but there's certainly grants that can help you with $500 to $700 that can go as credit towards your closing costs. So hopefully you have some encouragement hearing all the first-time buyer resources that are out and available in your local markets. Again, I'd love to be able to connect with you to figure out which resources we can pull from that make the most sense and create the best affordability for you. And we'll figure that out as part of your plan for homeownership. Our last topic for tonight's discussion, I think is probably one of the most important things to kind of review, is just the buying process. There probably isn't a day that goes by that I don't get a question about, where do I go from here, Jason? And especially after coming to a class and spending some time with me, I want you to know where to go after this. And our next step after class would certainly be to connect with you for that free consultation. That's a 30-minute virtual session that I'll do with you just to help design your plan for homeownership. Whether you're going to buy this year, it's a goal that you want to have a home by August or December, or you're just trying to plan for the next 3 or 4 years, we're going to be able to get together with you and partner with you and build that plan and set some goals, whether that's a savings plan or figuring out the assistance programs. Now, once we've kind of designed a home buying plan for you, the output of a consultation is to be pre-approved. And a pre-approval basically allows you to start seriously home shopping. It doesn't have to be this year. It can be next year or beyond, but you have kind of the baseline of eligibility for you with a pre-approval. Now, a pre-approval is always good for 60 days, but it can be recertified at any time. So if something's changed for you financially, we'll be able to recertify it pretty easy. And we can customize that pre-approval based upon what you're finding in your home search. So that's step one in kind of the buying process. Now, we're going to take you through the rest of the milestones, but step two is the home search. And that's probably the most enjoyable part of the buying process. Because now you're pretty excited, you know what you qualify for, and now you're going to start going out in your local community that you want to buy in and find the right home that kind of checks all the boxes. I would encourage you to get connected with a local realtor that should be an expert in their market, should understand all the attributes that you're looking for in your community. If you need a trusted resource, we're more than happy to introduce you to one of our preferred realtors that's in your local markets. We can make that introduction after your pre-approval consultation. But step two will generally start online and then eventually kind of transition into in-person, maybe going to some open houses and all that stuff. And then you might start finding a few properties that you like, and then maybe you identify the one and you decide to make an offer. Well, you might not get that offer accepted on the first go around. Might take a couple times or tries to find the right home, but at some point you will have an offer accepted. And if that offer accepted, then we move to step three in the buying process. Now, we've had several clients that got their offers accepted today. In most parts of the country, from the date of acceptance to the date you get your keys, it takes about 30 days to go through the buying process. In some states like Oklahoma or Texas, it could be 45 days, depending on what the seller needs for their closing time period. But the rule of thumb, it's usually 30 days to go from accepted offer to get the keys to your house. Now, the day you get your offer accepted, you're going to get a call from me saying, hey, congratulations, you did it. Your offer is accepted. Let's talk a little bit about next steps and what you should expect to see from our team to help support you. You're also going to have some action items that you're going to have to do, which will include generally making a deposit on your home, which is usually 1% to 2% of your sales price, but it does count towards your out-of-pocket expense. You and I will schedule a follow-up virtual session time to go through all the elements of your home purchase, including contractual timelines, all the numbers involved in your home purchase, the application of assistance programs if that's something you decide to do. But we'll kind of get that all figured out within a couple of days of your accepted offer. Now, that deposit that you make towards your house does count towards the total out-of-pocket expense. In most parts of the country, it's like 1% to 2% of your purchase price. And it's held in with a title company or escrow company or maybe even an attorney's office as we go through the buying process. And most contracts across the country have stipulations in the contract called contingencies that protect that deposit. So if something doesn't occur in the contract or something kind of falls out in the purchase, you have the protections of your deposit. Those contingencies usually center around appraisal contingencies to make sure the value is there for your home, inspection contingencies to make sure the house checks out, and your realtor will organize those inspections. As your lender will handle the appraisal and have that ordered, and then get your loan approved. We want to make sure all those boxes are checked to make sure everything is solidified in your home purchase. Now, once that is all in place and all those things are checked off, then we're going to be in position to continue in the process. At step 4, we're going to be doing more of the administrative phase of the process. We're going to be doing verifications of employment, verifying your assets, making sure all the product is set up correctly. Now, as I mentioned earlier, interest rates change daily throughout the trading day. Now, once you're under contract with the seller, we're going to start having conversations about the timing of locking in your interest rate. Because with the very volatile market that we have right now, there's little windows of opportunity to seize a low rate opportunity. The markets may be great one day, they might not be so good the other day. So we're going to have some counsel to you about, when we should be locking in the interest rate. We do a lot of that during your follow-up virtual session. Well, as we make that progression across our timeline here, step 5 is going to bring us to the loan approval phase. By that time, we're probably at the end of our contingency phase in the buying process. We have your loan approved, appraisal's done, your inspections probably check out. And throughout these different milestones, you're going to be getting disclosures sent from us that are all for e-signature. Now at step 5, you're also going to get a final closing disclosure that gives you a 3-day cooling off period before we get to the very final milestone. And that's called the closing of the loan process. Now in states like Oklahoma, for example, it's what we call a table funding state. So the date we close is the date you sign your final loan documents, that you deliver your final funds. And as your lender, I'll be sending our final funds for your financing as well. And everything gets closed and recorded that day with the local county's office. So a lot happens on that day, but it's a huge day of celebration too, because guess what? That's the day you become the owner of your home. And there's not a day that goes by that I don't get a chance to congratulate someone on achieving the goal of home ownership. It's such a cool experience for them, obviously, to go out and have that sold sign in front of your new house and get your keys and start moving. It's a pretty special thing. Our relationship with our clients doesn't stop there. We have our aftercare process, which is essentially staying connected with you after you've purchased your home, whether that's keeping you top of mind for any rate reductions in the marketplace to seize a refinance opportunity, or just giving you tools like our HomeBot system to track your home equity and just checking in with you on an annual basis to see what's happening with you financially. Obviously different things are in the seasons of life. Things are changing all the time. And so we just want to make sure that we're here as a resource for you. Well, as we get wrapped up for our discussion this evening, I just wanted to kind of share with you how you can take the next steps in moving forward if you want to get connected with me for your free consultation. It's a simple process. It involves just doing an online application that takes about 2 to 3 minutes. We do a soft credit check, as I mentioned during our credit segment, but it does not impact your credit score. You'll then upload some documents, and then you'll use our scheduling system to schedule your free virtual consultation. We can do that via phone or in a Zoom session. I always prefer Zoom because I do a lot of screen sharing. We record the session so you can kind of look back at it. And I think it's just a great way of kind of just working together to design your options around home ownership. That's a great place to kind of launch into just figuring out, is this the right move for you? As we're looking at what we talk about in the consultations, very similar to our discussion this evening, we talk about budgets, credit opportunities, first-time homebuyer programs, the process, and then the output of our discussion will be hopefully to get you pre-approved to help get you ready to find the right home that works for you, and of course, accomplish your goals of home ownership. We like to embrace technology in our process, whether that's mobile, using some of our AI tools, but I always like to share with our classes, it doesn't replace the human touch of our business. This is a very important financial decision. So we want to make sure we're always connected with you, but whether it's call, text, email, just make sure that we're there for you as an outlet at any time. Now, part of our benefits with our Oklahoma State alumni community is that we pass along discounts in our services. So not only do we have our classes you can attend at any time, is we also discount our services that we provide to you in home ownership. So we discount our lender closing costs. Of course, you're always welcome to come back to one of our classes. We'd also encourage you to share this with your friends, family, or coworkers. If you feel like this was a useful class for you, love to be able to see them at one of our upcoming classes. We also have other partnerships across the country that we have very similar classes that you can always attend at any time. Here's all my contact information. So, of course, I'd love to get connected with you after our class. So feel free to reach out to me. Any way I can help be a support mechanism for you, maybe just to bounce ideas off me or just to kind of better understand one of your situations that you want to kind of run by me. I also want to kind of encourage you to check out what our community says about us. As a leading provider in education and first-time buyer tools, we're really proud about what our community says about us and our experience that we provide all across the country. So I would encourage you to follow us on our Instagram, and we'll have this video up on our YouTube channel tomorrow. So feel free to look back at our recorded class. We'd love to be able to get that out to you, and we'll get all the presentation materials to you as well. Well, that brings us to the end of tonight's class. I've really enjoyed presenting this to you, and hopefully you've had one or two takeaways for you to help you in this journey towards homeownership. I do want to open it up for any questions that the class has that we can cover before we wrap up. And then hopefully we'll get a chance to get connected here at some point. Any questions from our class? Okay, so one of our questions came in just now, which was, for someone without a credit score, is it feasible to get a loan via manual underwrite, or is it better to start building a credit score? So yeah, I mean, there are manual underwrites for programs that we can do, and we do that in-house as a direct lender. So we can certainly look at that. I would also want to have the conversation of building a credit score. If you're not on the map right now with credit, it usually takes about 6 months to generate a credit score. Sometimes there's really low-hanging fruit opportunities to build your credit score. If you have a partner that you're applying with and maybe you don't have a credit score, but they do, you might be able to get added as an authorized user to their score, or to their accounts, or maybe a parent that's willing to add you to their credit file as an authorized user. So there's a variety of different things we can do, but manual underwriting is a tool that's available to us for sure too. What are the best sources to use when starting the search for who to use as a loan lender? I mean, there's a variety of different resources to pull from. I give a lot of clients that, search me in Gemini or different AI tools to learn a little bit more about how I support my community. I think coming to a class like this, hopefully you found, we're really about pouring value into our clients. And so we do things a lot differently than most lenders because it is such an important financial decision. So we start with education and then help support you through the buying journey. But we'd love to be able to be a partner with you in that journey together too. So, but I think, finding some searching, doing some kind of reconnaissance on someone online, I think is really important. But I found that a lot of clients just find me through different AI tools. Okay, so I answered that one, and thank you for the thanks in the chat. I appreciate that. Very nice of you. Any other questions from our class? Okay, one more came in. Okay, so I was asked to talk a little bit more on escrow. So yeah, we can certainly do that. So escrow is basically the time, and tell me if this isn't covering what you're looking for, but escrow is basically the time period from the accepted offer to when we close escrow. So usually that's the 30-day process. That's one side of it. And we kind of went through that through our buying process. You might be asking about an escrow impound account, perhaps, and just tell me if I'm wrong. On that side of it, an escrow impound account is where a lender is basically administrating the payment of your taxes and your insurance as they come due. Taxes in some part of the country, property taxes that is, are due sometimes once a year for your property. Other parts of the country, they're due twice a year. And so an escrow impound account in your mortgage will help facilitate the payment of those based upon the frequency that they're due. And then I'll also pay your homeowner's insurance when it renews next year, or the following year, I should say. And so in most parts of the country, when you put 10% or less or use a first-time buyer program, you have to do an escrow impound account. So you can't pay them on your own. If you do more than 10% down, you can pay those out of your own budget. So for our audience member, hopefully that was what you're looking for. If not, just please go ahead and send me a chatter, and I'll kind of expand a little bit more. Okay, awesome. Well, you've been a great class. I appreciate the participation. Hopefully get a chance to connect at some point in time. If there's anything I can do for you, please don't hesitate to reach out, and look forward to seeing you soon. Have a wonderful night.